Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Hi there and welcome to Better System Trader. This is episode number 136. It's great that you've joined us today. Now, before we get started for this episode, I just wanted to remind you of the announcement I made at the end of the previous episode, number 135, and that is that I'll be taking a break during December, so there will be no weekly trading thoughts released during that time. However, the fortnightly podcast will still be released, so it's just the weekly trading thoughts that are being put on hold for the remainder of 2017. Now, one of the things I'll be doing in December is taking the family on a holiday. We've booked a villa in Port Douglas and we're all really excited to get there and start enjoying the holiday. And I remember reading an article in the Huffington Post last year about vacations, and they were referencing a study published in a journal that said that just planning or anticipating your trip can make you happier than actually taking it. Now, I'm not sure if anticipating a holiday is more fun than actually taking it. I guess that depends on whether you have to take your kids or not, but there is definitely value in anticipation, which ties in quite nicely with this podcast episode. Our guest for today is John Carter, and John is going to share with us the value of anticipation in trading and how anticipating market actions and the pain points of other market participants can actually give us an edge in trading. And some of the other topics we'll also be covering include a simple but powerful mental switch that can crush the fear of executing trades. We'll also discuss the subtle clues that tick and volume data give to indicate if a trend or range-bound day could be more likely. And we'll also talk about techniques to identifying potential false breakouts and how stop runs can actually improve your trading results. Plus, we discuss much more, so let's get started by heading over to my chat with John Carter. Hi, John. Thanks a lot for joining us today. It's really great to have you here on the show.
Andrew, it's great to be here.
All right, awesome. Well, can we just start with a little bit of background on yourself? So can you tell us a little bit about yourself and how you got started in trading?
Yeah, it was one of those things I kind of stumbled into it. Growing up, my dad was a broker, and through osmosis, I just kind of started picking up the lingo. I would overhear conversations that he'd have with clients, and eventually I just got interested in it. I think it's one of those things that, from a trading perspective, when you try trading, it either immediately clicks and you think, oh my gosh, people can do this for a living, or it makes absolutely no sense and it's gambling and you should never do it. For me, obviously, it was the first one. I was like, this is amazing that people can do this. And so I fell in love with it. And it's been kind of a lifelong journey since I was about 19 to continue to improve my skills.
Yeah, okay. So you've kind of been set up from an early age, watching your father and other traders. So how did that kind of direct your trading today?
What's interesting about it is that even early on, I got to see a lot of the pain and anguish that other people experienced in the markets. And of course, when I first started off, I experienced a lot of that on my own as well. But, my side of it was always the idea that it was more of an individual thing. And what can an individual do for extra income or, the daily challenge of them against the markets versus, some hedge fund being run, on a computer. And so that's always been kind of the interesting thing for me was always the idea that trading, if you learn the skill set, was an opportunity for freedom. It was an opportunity to better your own skills to, work when you wanted to and things like that.
Yeah. Okay. So if we fast forward to today, what types of, what markets do you trade and what types of styles do you use when you're trading?
So I'm primarily I call it, I'm not a scalper, but I'm kind of a day trader to swing trader. I generally like U.S. stocks, options on U.S. stocks, and then I'll trade the futures markets. And of course, the futures markets cover a lot of asset classes. And it just depends. If the stock market is hot and heavy and going strong, I'll focus on that. And then if there's other times, because the asset classes, money flow kind of goes in and out. And so there'll be periods of time where the stock market is choppy but man, the euro is on fire, or, crude oil is doing something. And so I really just, I don't really care what it is, as long as it's exhibiting a specific type of behavior where it's kind of I call it a greater than expected move, where there's some momentum there. And that's the sandbox that I like to play in.
Yeah. Okay. So do you have like a kind of like an overall philosophy or an approach to the markets that you trade?
Well, I was going to laugh and say, bet it all. And if you have a good trade, retire early, but that never works. But what's interesting is that when you're trading, there's other people out there that are doing that. So keep that in mind when you're placing, trades. But my general philosophy in trading is that the greatest opportunities present themselves when the largest amount of people are experiencing the most pain. And that's just something that, unfortunately I had to learn the hard way when I was experiencing, the maximum amount of pain, and realizing, gosh, somebody else is on the other side of this trade.
Yeah. And
it really got me into looking for situations like that, whether it's, a short squeeze or a stop run and different things like that. But I like to, you have to assume that everybody knows what's happening today, and the market is fairly priced today. So something nasty has to happen for a big move. And so I keep an eye for things, where is a potential nasty thing that could happen that's going to cause a lot of traders to panic and do irrational things.
Yeah, I think that's an interesting take because, understanding the psychology behind a trade, trading psychology is talked about a lot, but more from the aspect of traders trying to manage themselves and execute their own trading operations. But really understanding the psychology behind a trade perhaps can give you an edge, as you mentioned there. So what type of things are you looking for when you're looking at trying to understand the psychology of other traders that perhaps you're trading against?
So as an example of one that I really like is that you'll get, I call it day 3 margin call, where, you get, say, Wednesday, the market sell off, and it's been rallying. So you just kind of sit there and look at that and say, okay, so there's a lot of people that are long. They're now, maybe they're doubling down and hoping that the next day it rallies. And then the next day, it's actually an even steeper decline. You close at the lows. Well, now the third day, really what they're doing is they're hoping and praying to the trading gods that the next day is a rally. Because if there's not a rally, they're going to start getting margin calls. Because we all know that people are supposed to trade responsibly, but everybody just maxes out their margin if they really like something, right? And it's when they get blown out of their positions by their broker is when you get that huge move to the downside. And the thing about it is that markets play this out. Like the algos understand that this is going to happen. So if you see 2 kind of big down days in a row, just think that third day is designed to wipe everybody out and just to, take advantage of that. And I'd like to say that trading as all of us traders holding hands and singing zippity doo-dah and making money. But the reality of it is that, it's a little bit of a war. And my favorite wars are the ones when, as retail traders, we're taking money from the hedge funds. Of course, that's better. But, psychology is psychology, and we want to make sure that we understand what's going on the other side of the trade.
Yeah, I guess that type of approach, you're kind of thinking about the pain that the other market participants are in and when they're considering to exit. But what about considering when they might enter? How can you kind of use that to direct your own trading?
So one of the philosophies that I really like is that another person's stop loss is my ideal entry. And this just kind of came about from, how many times I'd set up trades and I'd get stopped out, and then magically, the market would turn around. And part of this has to do with confirmation bias. So traders, all the indicators that they're watching look good. Well, by the time that they all look good, it's kind of too late. But that's also when a lot of people get in, right? And so everybody, a lot of times people get in a little late, and then they just get flushed out on a normal pullback. And so if we keep that in mind, it's kind of like the moment you see this picture perfect, all the indicators look great, everything's crossed the buy signals. Well, at that time, it's kind of the move is mature. And just keep it in mind that if you're buying there, that's great, but go in with like a third size, expect that flush, and then pick up the rest, on that flush. But there's things like that happen all the time.
Yep. It says in your bio that you like being in trades before anyone else. So where does that kind of approach come from?
It's interesting, and it's probably more from kind of growing up and watching my dad's experiences. But the idea is that whatever you're doing today, okay, and I kind of think of it sometimes as a trader. Think of it as we're Walmart, okay, and Memorial Day is coming up. And that people are going to be coming to the store and they're going to be willing to pay $3 for hot dogs. And 10 days before that, you can get them at $1. So you're loading up on the hot dogs today with the idea that you could sell them, for $3 in 10 days. Well, that's just a way of saying that when you're looking at a chart today, try to imagine that, if everybody likes it, everybody's already in it. So it's not going to go any higher. So it's what's going to cause people in 4 or 5 days to really like this stock. So that means that when you're buying it, it looks like crap. You're not going to get all the normal signals that this perfect, nice, confirmation signal that everybody's looking for. And so it's just looking for triggers to get in, kind of anticipating that it's going to get to that point.
Yeah. So I think the using those type of approaches, the advantages are quite obvious. But what about the dangers of doing that? There can be some dangers with getting in too early. So what should people look out for if they want to take that kind of approach?
So that's an interesting question, and I struggled with it for a while, except that I got to a point when I realized that as long as you understand your risk, it actually doesn't matter when you get in. So if you get in when it's perfect, it's like, oh my gosh, everything looks perfect, and you're willing to risk $2. Okay, well, get in when it's scary, and you're still willing to risk $2. It's the same thing. And you'd be surprised that the trades that, when they feel the scariest, often turn out the best. And there's nothing to fear because if you know exactly how much you're willing to risk, then you've got absolutely nothing to fear. And that's where I think people can get confused, where it's like, oh my God, this is so scary. It's like, what does it matter? You're still risking the same amount on this as you would if it was, if it looked perfect. So, it's a little mental switch there to kind of push fear aside and just focus on the risk.
Yeah, and I think the risk is also kind of a byproduct of the mood of the market for that day, because market moods can change pretty quickly and they can be different from day to day. So what kind of techniques do you like to look at, or what are you looking for when you're trying to judge the mood of the market for that day, or perhaps even throughout the day?
Well, so it depends on the market. If we're looking at the U.S. stock market, I'm a big fan of a couple of internals. Namely the NYSE tick. So it's usually on a platform as #TICK. And that just measures kind of the conviction of the overall market. And so if in the first 30 minutes, the tick reading is staying, above plus 400 consistently and going into those +6 and +8 and +1,000 levels, you've got massive buying conviction in the market. And that's typically a trend that's going to last all day long. On the other hand, if you're just kind of batting back and forth between +400 and -400, you've got a choppy market. And what's nice is that you can kind of understand the flavor of the market by looking at that. And if you've got a market with conviction, great, you can buy breakouts. Okay, but if it's a choppy market, you don't want to buy breakouts. You want to short those breakouts and buy them back on the retracement. And so anything like that, the earlier in the session you can understand the personality of the market, the better. It's not easy, but the U.S. stock market has nice tools for that. And if it's another market, then typically I like to look at volume on that particular day when compared to other particular days. So if, normally in the first 30 minutes, it's traded, 30,000 contracts, but on this particular day, it's trading 60,000 contracts. It's like, wow, there's some real action coming into this.
Yeah. I was going to ask about volume, because the tick, it tells you the difference between the stocks going up and the number of stocks going down, but it doesn't really tell you where the volume is. It doesn't tell you if it's small caps taking up all the volume or some of the bigger stocks. So what other kind of, do you use any other kind of internal measures to try and judge the markets for that day?
Well, so I actually do look at the tick on the major indexes. So there's a tick for the NYSE, S&P 500, the Russell, the NASDAQ, And so that does help kind of isolate, is the conviction in all the indexes, or is it really more in the Russell? And so that's actually a nice thing too. The other thing I like to look at is I'll scan all the markets, all the sectors, and all the major asset classes, and really look at that net percent change. And anything under 1% on a net percent change basis is pure noise. Anything over 1% is conviction. So, if the stock market, I'm looking at it and, S&Ps are up 0.5%, but the NASDAQ's up 1.25%, it's like, wow, that's where the conviction is this particular day. And that trend tends to continue.
Yeah. Okay, I just want to move on now to intraday trading a little bit more. Well, we've actually already just started talking about it, I guess, but it can be very challenging to trade intraday time frames. So what do you think are some of the things that traders need to consider when they're looking to do that?
Well, so first of all, everybody that's actively day trading, especially if they're newer, they really have to take into account the amount of commissions they're spending and the amount of psychological capital they're also spending. And I say that because there's a couple of things to keep in mind. First, there's a very, very common thing with day traders is they make money in the morning and then they piss it away in the afternoon. And the reason for that is that and this is like a proven study, is that the longer someone stares at a screen, the more impatient that they get. So in the morning, you're fresh, you're objective, but then in the afternoon, impatience creeps in and you just start committing errors. And so the first thing is I would encourage someone who's day trading, have a window, 3 hours in the morning and you're done. It's okay if you miss other moves, but that'll typically improve traders' results. The other thing is with commissions is that commissions is the big hidden cost, and you need to take whatever whatever an average daily commission is and multiply that for the year. So if you're spending $75 a day in commissions, that's $18,000 over the course of a year. So just make sure that that is acceptable for the account size that you're trading. And the best way to combat that is to trade less. Instead of looking at a 1-minute chart, look at a 15-minute chart. Look for setups that have a little bit more juice, as opposed to those 1-minute scalps.
Yeah. Yeah, I think as well, something that you kind of touched on a little bit earlier is that some of the moves in intraday trading can be almost set up like they're there to suck traders in, like a bait and switch kind of thing. So what kind of things can traders look out for that may be perhaps a sign that they should watch out, or perhaps they need to get out?
So a couple of things there that I'll look for. And one is that when the market's kind of, usually there's some volatility in the morning, and then in the afternoon, things kind of quiet down. But typically intraday, there's always what I call a flush. And either way, so if we've been falling, at some point, the market's kind of, I always think of it as who are they sucking in at the last minute? So a lot of times there'll be like, say, a breakdown, wow, the stock market just made new lows, and then they turn around and rip higher. And those to me are always fascinating. So just kind of be on the lookout for what I call those flush and reverses. And those are, the computers, the high frequency traders, the algorithms. If you think of them as sharks on the hunt for liquidity, it really helps set your mindset up. And typically where the liquidity is, a lot of times, is where the most stops are. So if you look at a pattern and think, wow, a lot of people must have got long there on that breakout to new highs because everything looks so good. And if things start to kind of drift down, think of the computers wanting to go on a hunt for liquidity. Well, the liquidity is going to, it's no secret where everybody's going to have their stops. They don't need to see them. Everybody reads the same books. And so they'll come down there, rip it down, get that liquidity so they can get their transaction done, and then let the market do it at once. And so if you start thinking about the markets in that perspective, it just becomes a different, it just becomes a lot different than, I think this is going to go higher. I'm going to buy it. Well, so does everybody else.
Yeah, no, that's an interesting way to kind of frame the way you look at the markets is thinking from that angle. But it sounds like from a lot of comments you made, you're using a lot of price action to judge the markets. Do you find that price action gives you a better indicator of the markets versus indicators, or do you think there's a mix there? How do you approach that?
Definitely a mix. I mean, there are some indicators I like quite a bit. I do like to watch is an indicator I like called the squeeze. It's essentially just watching the Bollinger Bands get to a point where they get really narrow. And typically at that point, it's kind of like a compression in volatility. And at some point that, it's like if you're holding a puppy in your hands, after a while it's going to start to squirm and try to break out of that. And the markets are the same way. So, I really like to look at things when they get a little too quiet. I always look at it as they're building up energy and they need to release that energy. So that's something that I like to look for. And then I am a fan of levels, Fibonacci's, pivots and things like that. And typically in something like that, the first test is typically good. The second test will usually rip through it. So there's kind of a saying like the first test fade it, the second test go with it, meaning the first test will hold, but the second test will break through it. So there's things like that I kind of generally like to look for.
Yeah. I think as well for traders that there can be a tendency to want to tinker with strategies, but market conditions and characteristics change. So you mentioned volatility there. We've had some decline in volatility over time, obviously with the occasional spike. How do you balance the desire to tinker and adjust strategies with the need to adapt to changing market conditions over time?
Hey, that's a really good question. And I kind of look at my trading universe in blocks of 25 trades. And so I just kind of really let that tell me how my perceptions of the market. And if my last block of 25 trades was a net loser, it really tells me something about what I think the market's doing and what the market's actually doing. And when something like that happens, then I will do some tweaks. But if at the end of a block of 25 trades, it's like, wow, I've, made some decent cash there. I'm not going to screw with that. And so I really let the actual results tell me if it's appropriate or not to tinker with it. And typically tinkering with something, I would say that probably the number one thing you can do as a trader to increase your profitability is to cut your position size in half and double your stop. A lot of times people trade a little bit too big with a little bit too tight a stop, and they are ripe for the picking for those computers that are out there searching for liquidity.
So when you're looking at the 25 trades, are you looking at 25 trades for the same strategy, or are you looking at across a portfolio of strategies? How do you manage that?
Great question. So I look at it per strategy. So,
right.
I just kind of track it in terms of, because, on any one trade, you really can't put too much importance on one trade. I mean, anything can happen. Some intern at a hedge fund could hit the wrong button and it flushes your stop, and that happens. And so you have to look at it in the context of 25 trades. And it's actually nice because it puts a lot less pressure on you too. And if you think like, God, this thing just got me stopped out, it's like, oh, well, it's just number 13 of 25. So it's not a big deal. And so that kind of helps, I think, or at least helps me kind of follow my plan as opposed to, making every trade a life or death scenario.
Yeah, and when you're trading intraday timeframes or if you're scalping, they're very short-term trades. Do you also consider higher timeframes as well to kind of guide you into what the markets are doing at a bigger picture, I guess?
Yes, and I actually think that's something that's more important than a lot of people realize. Well, at least people, if you're just looking at a 5-minute chart and that's it, you're missing out on so much stuff. And so if I'm trading a 5-minute chart, and typically I actually like to trade time frames a little higher than that, but let's say it's a 5-minute chart. So if I'm looking at a 5-minute chart, I'm also going to look at a 30-minute chart and even a daily chart just to make sure that I'm not freaking out. On a 5-minute chart, the S&Ps could sell off 7 points and it looks like Armageddon. But if you can reference that to the 30-minute chart and the daily chart, you're like, oh my gosh, this is the flush. This is the stop run that I was looking for. And so I think that's something that just helps, it helps traders keep perspective, because if you're staring at that small time frame chart, you can get caught up in this vortex of emotion and impatience that causes people to do really hasty, impulsive things.
Yeah. So you've done work with a lot of traders. What kind of challenges or struggles do you see traders make?
The two biggest things I see consistently is once they've got some trading under their belt, because everybody comes in with the beginning mindset. And the beginning mindset has an advantage. They don't have wounds that they're carrying with them into the next trade and stuff like that too. But once they have, some actual trading under their belt, the biggest problem I see is just fear. They get really, really scared of, losing money. And unfortunately, that mindset causes people to lose more money. It causes, the irony, right? You think that, okay, if I'm fearful of the market, I'll be more careful. And so the biggest thing I had to say with that is that, anybody who's been trading for a while is going to have some really crappy situations that they've been in. And, the gift as a trader you can give yourself is just to wake up the next day and give yourself a clean slate. It's like, all right, that was my tuition. I've learned some skills. I'm not going to carry that baggage with me. Now, act as if you're a professional trader and start acting like that on your next trade and do that on each and every trade. And what happens with that is, because we all know when we're doing stupid stuff, it's like we're sitting outside of ourselves going like, oh my God, I can't stop. But as a professional trader, what are they doing? Well, they're not over trading. They're pre-planning their trades in advance. They've got levels that they're watching. They're using limit orders to get in. They're being patient. And if there's nothing to do, they're not trading. And if we just recognize that and give ourselves a break and, forgive all of our transgressions of the past and just start doing that right now, it sounds silly, but if you can really do that, it just clears up so much of that, extraneous crap that we carry around with us. And it's just as simple as like, all right, you know what? Clean slate. This is day one. And from now on, I'm going to act like a professional trader. And it can really turn things around.
Yeah, and what about the more experienced traders who do perhaps have some time under their belts? What kind of mistakes or challenges do you see they make?
The biggest thing there is just fatigue. Trading is a lot more intense than people realize. Now, if you're doing pure systematic trading, it's not as intense. But if you've got some discretion in some of that, there's going to be a lot of emotion tied into that. And I would say that, if you're a day trader, pick 3 days a week to trade. Take the other 2 off, get away from the market, or just watch them. And what's amazing is during those 3 days that you're trading, you're going to be a lot sharper. You're going to be a lot more focused. You're going to be a lot more resilient. But the markets, if you're doing it day after day after day, wear you down. And I think that's just a big thing to keep in mind is you don't have to trade, all the time. I mean, one of my trader friends that really at some point I'm going to copy his model. He trades really hard from January through May, and he takes the rest of the year off. It's like, what? That's a pretty awesome idea. So, and we're all market junkies, and I like to see what the market's doing and things like that. But there's something to be said for sharpening the saw, so to speak.
Okay, just one final question before we start wrapping up for today. So for traders who wanted to get started in intraday trading or day trading, what would be your advice to them?
So it depends. So if you're learning a new platform, okay, you download the software and you just don't know how to use it, start off with the demo account until you get comfortable with the software. But other than that, I'm not a fan of demo accounts at all because they don't teach you how you're going to react under pressure. It's like if you're in a demo account, you don't care. I would just say that, it's prove to yourself that you can do it. Start off, if you're trading futures, right? Or start off with a 1 lot. And if you can make money after 10 trades on a 1 lot, bump it up to 2. All right. And that way your tuition costs are going to be cheaper. But the worst thing that can happen to a new trader is that they come in with a beginning mindset, which is the mindset that you want. So typically the first couple of trades work out and then they get whacked and now they're fearful and then they bring fear into the markets and then it just becomes a spiraling, disaster vortex of pain and suffering. And, instead of that, just build up the skill set. Trading is a skill, like golf is a skill. If you're going to get better at golf, you have to sit there and you have to hit the club, make contact with the ball, see where it's going. And on every swing, you've got to be focused and you've got to be neutral. And it's the same way in trading. And, if you remember that, and, if the last 3 trades were winners, don't bring that enthusiasm into the 4th trade. Okay. It's going to cause you to do stupid things. If your last 3 trades were losers, same thing. Each trade is a new stroke of the golf club, and you got to get back into that neutral state of mind and hit a clean shot. And that's the kind of stuff that'll help make it something that's, more pleasant through the ups and downs.
What about traders who perhaps are trading in other time frames already? Perhaps they're swing trading on day charts. How does those kind of skills translate into intraday trading?
Well, for swing trading, it's interesting. The best thing you can do swing trading is not stare at the charts. So typically if you're swing trading, and I like swing trading where you've got to trade on for a couple of weeks or more, you just kind of get your stops in place and then just wait. The worst thing is you're in a stock and you're long, and then you're looking at a 5-minute chart and it looks like a disaster and you just get out, right? And it's just like, but it was perfectly fine. And so you got to keep in mind that, remember the reasons that you got into the trade in the first place, and don't confuse time frames. The time frame that you took your signal on is the time frame you use to monitor the trade, and that'll help save a lot of impulsive mistakes.
Yeah. All right. Thank you very much, John. Now we're going to start wrapping up now with some quick closing questions.
Okay.
Okay. Ready? What's the biggest lesson you've learned through trading?
The biggest lesson I've learned through trading that I've been also able to apply to my own life is to let go of the outcome. Do not try to impose your will on the market or anything like that. Anytime I've done that, it doesn't really work out too well. So, set up your trade and then let go of the outcome and let it play out.
Yeah, good advice. All right, what do you think is the most important ingredient to becoming a successful trader?
Really understanding the idea of fear and risk. And it's easy to focus on the fear of the unknown. All we got to do is instead focus on the risk of the unknown. And then we just need to be, and this is one of my favorite quotes from Mark Douglas, we need to just understand with 100% conviction that we have no idea what's going to happen next. And once you kind of get into that mindset, things get a lot easier.
Yep. Okay, thank you. And what's your favorite trading book or books?
Oh, boy. The one that stands out to me the most is How I Made $2 Million in the Market by Nicholas Darvis. It's kind of a trading classic, but that's the one I remember when I read it just going, it really resonated with me. From there, on the psychological side, I like Trading in the Zone by Mark Douglas. Those are the two that'll stand out. I mean, there's other fun books that are out there, but those are the two that certainly stand out.
Yeah. And what's the best way for listeners to get in touch with you or to learn more from you?
Well, we've got a website, simplertrading.com, and on that site we have different modules for options, stocks, and futures. There's a group of 10 of us. We're sitting there trading throughout the day. We send out text alerts on things that we're doing and have a lot of fun. So if you're a beginner, it's a good place to learn. If you're more advanced, it's a great community where we're sharing ideas and kind of helping each other through the day. And it's a lot of fun.
Yeah, cool. All right. Well, thank you very much, John, for your time today. It went so fast today. I can't believe it's almost done. But is there anything else that you'd like to mention before we finish up?
No, I think that's it. I hope at some point I can get over to Australia, and if I do, I'll maybe hit you up for a beer or something like that.
Sounds good. Awesome.
Okay.
Thanks again, John. I really do appreciate your time today and wish you all the best.
Thanks, Andrew. You too.
Cheers. Bye. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.